The following program sponsored by Adams Financial Concepts.
About money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth, and has a proven track record of managing long-term investments surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
It's Friday afternoon, and we're going to be talking about money. Later in the program, I want to talk about an event that happened, an event where an astonishing number of children disappeared. An astonishing number of American children disappeared, and it all happened on one day. Just one day? Anyway, we'll get to that later in the program. It's been over a year now that the market has not been at a new high. The last time the stock market reached a new high was on May 21, 2015. We've gone 14 months or 13 months without a new high. That's a long time. Actually, May 21 to, I'm getting ahead of myself. It's been just a little over a year. Okay, so we're in June, May, the numbers don't quite add up to 14 months, but we're close. But it's been over a year since we've seen a new high in the market. Market essentially, if someone had gone to sleep a year ago and woke up today, they'd say, gee, the market has been flat during this whole time. But it's not been. Randall Forsythe, who writes a column for Barron's, calls this time the twilight zone. The twilight zone of the stock market. The reason is if you look at what's happening in the investment world, global stocks at the end of May were off 8% for the year. Commodities lost 22.3% during that time. European bank stocks are back to the level they were in 2008 when Lehman Brothers went down. Those were low period. And 2013 Greek default lows. I mean, we're back to that time. Japanese bank stocks are down 30%. Chinese bank stocks are down 40%. Oil's down 60%. Gold's down 35%. It doesn't look like a pretty picture. And yet the stock market is only down 2% from that period of time. That's pretty encouraging when you think about it. We haven't seen a year like this since February of 1995. That was 21 years ago. So if the stocks are only down 2%, and when you think about global stocks and commodities and European bank stocks and Japanese bank stocks and Chinese bank stocks and oil and gold, all that very difficult time in other investment areas, being down 2% is pretty encouraging. Not that there aren't a lot of concerns. I mean, $20 billion has come out of mutual funds, stock mutual funds in the last year. $20 billion less invested. Hedge funds have been losing billions of dollars. It's been a terrible time to be in hedge funds. Private equity has been struggling. Emerging markets are struggling. Junk bonds are down. China's down. And yet, the Standard & Poor's is only down 2%. I believe that history doesn't rhyme, or it doesn't repeat, but that it rhymes. And I think there's some lessons, because the last time this happened was in 1995. In 1995, people looked at the stock market having been flat for a period of over a year, and the New York Times came out with an article in January of 1995 that said, prepare for what they called, and they put it in caps, a big, deep bear market. A big, deep bear market. That was the forecast. That's what people were talking about. They were talking about it was going to be like 2008, 2009. That's what a lot of the prognosticators were predicting in 95. we were going to have a market that was down 25 or 30 or 40%. That's what they were looking for in 1995 because the market had been flat, hadn't gone anywhere. There hadn't been a new high in over a year. So what really happened? We didn't have a big, deep bear market. Instead, the Standard & Poor's went from 487 to 1,366 in 5 years. That's a 280% increase in 5 years. If you can put that in today's terms, with the Standard & Poor's now at 2,090, and if in the next 5 years we see what happened in the 1995 to 2000 time period, that would make the Standard & Poor's go from 2,090 to 5,890. Put it in the more popularized Dow components. The Dow now sits at 17,826 at the end of May. That would make the Dow in 5 years 49,840. Almost 50,000. I've been saying now for almost 6 years to expect that we're going to see the Dow at 100,000. Could it be in 5 years? It's very possible. Probably not. You know, as I talk about these things and talk about something like the Dow going to 50,000, it's one of those things that you sit back and think, it's just not going to happen. It's, you know, that's a long way away. And yet, in 1995, with the Dow sitting down at just over 3,000, who would have expected it would have gone from 3,000 to 10,000? A threefold increase. But that's what happened. That's what happened. You know, I remember coming through this period of time, and I gave a talk at Rotary in 1998 talking about the market. I used to be asked for a certain Rotary club to talk once a year, talk about what was going on in the market. And I would talk most of the time about, year after year, I talked about the market climbing a wall of worry. There were this problem and this problem and this problem and this problem. But the outlook, in my opinion, on the balance, was a market that was going to be up. But in November of 98, I changed tune. I talked about a parallel between what Greenspan was doing and Archibald Young was doing. Both faced the same problem. Both faced an inflation of assets, not consumer inflation, but that both see their stock market begin to climb and climb and climb, and felt that there was an inflation of assets. For Archibald Young, he began to raise interest rates in 1928. And you know the rest of that story, because in 1929, everything came crashing down. And even though I talked about that and talked about the potential of that happening in the market, and it did happen in the market with the dot-coms, that was something that, even though I talked about the market coming down that far, it was hard to visualize. And even as the market came down, even though I'd talked about it, I couldn't bring myself to selling everything for worry that the market would turn around and go the other way. I had the premonition it was going to keep going down. I had the feeling. I had the data to show that it could keep it going down. But in the long run, you're better off riding through the down times into the up times. You know, the other thing that happened with that Rotary Club, after I had such a negative talk in November of 98, they never asked me to come back again. Year after year, when I would give them a positive outlook for the market, they would invite me back. But that year was my last year. You know, if you look back in that 1995 time period, we had some of the same problems then that we do today. If you remember 1995, there was the First Lady, Hillary Clinton, who was talking about health care. That was 1995. That was upsetting the market. That was upsetting the pharmaceutical stocks and even the biotech stocks. Orange County, California, filed for bankruptcy. Mexico, their sovereign debt was crushing Mexico and the Mexican economy, and Mexico devalued their peso. China was coming into play at that time, and China was having an impact on the market as well. Japan had crashed down in 87, and they were struggling again in 95. You had NAFTA that was passed, and all of the negative feedback that talked about it. It wasn't the TPP, it was NAFTA at that time, and the loss of jobs, and all the things that were being said about trade and have been said about trade in the past 6 months or 8 months, whatever the election's been, were being said about NAFTA at that time. The market was a market that was up 60% from October of 1990. The market had had a good run for the previous 5 years, up 60%. People couldn't see that it was going to continue to go. It was already a very old bull market, and a secular bull market that really dated back to 1982. And here we were in 1995. It had made a tremendous run, and people were really concerned that it wouldn't continue. The best-selling book of 1995 was Bankruptcy 1995, Why the U.S. Will Collapse it was a book by Figge and Swanson. Why the U.S. Will Collapse. Bankruptcy 1995. And yet it didn't collapse. Hang on, we've got more to come. And I want to tell you about the disappearance of those American children. That's coming later in the program. I got a great guest, too. Don't go away. We'll be right back.
About Money with Mike Adams will resume in a moment on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Lots of people manage investment portfolios. Just a few can manage a successful portfolio and provide exceedingly great service to their clients. Here's Mike Adams from Adams Financial Concepts.
We believe the price you pay should be based on the performance of your portfolio and the quality of service you receive.
Mike, it seems that a lot of companies subscribe to the one-size-fits-all mentality of investing. Does one size really fit all?
Not with us. Every portfolio that we manage is customized to fit each particular client's objectives and risk tolerance. We place our clients' interests first in all portfolio decisions.
If you're looking for a home for your 7-figure plus investment portfolio, call Mike Adams of Adams Financial Concepts, specializing in creating and maintaining wealth for over 20 years. 206-903-1019. That's 206-903-1019. Or log on to adamsfinancialconcepts.com.
We're back with more About Money. For details on what you hear on today's show, visit adamsfinancialconcepts.com. Now, here again is Mike Adams.
So I've been talking about the stock market, that it's been flat for over 1 year. Reached a new high on May 21 of 2015, and it never has gotten to that level again. But it's been basically flat, only down 2%. But there was a similar time in 1995, as I mentioned. The New York Times came out at the beginning of 1995 and said prepare for a big, deep bull or bear market. They were predicting a market that would be something like we saw in 2008, 2009. One of the best-selling books was Bankruptcy 1995, Why the U.S. Will Collapse. Why the U.S. Will Collapse. That was supposed to happen in 1995. It was by Figge and Swanson. But what happened was not that at all. The Standard & Poor's went from 487 in 1995 to 1366. The Dow, on a similar basis, will in 5 years, if we come close to repeating that, would be at almost 50,000 from its 17,000. That's half the way to 100,000, something that I've been talking about since 2009. Yeah, the market's been flat for a year. It's been down. At one point, it was down 16%. But basically, if you look at it in a longer range, if you look at it from a mile-high view, we've been basically flat, which is good news, not bad news. And yet, negativity sells. I say that again and again, but it's clear. We're very similar to where we were in that 1982 to 2000 secular bull market, one that was 18 years long. But selling negative things happens to generate more revenues than looking at the positive things. That gets people going. And yet, for the people that sell out, that develop that fear, that want to move out of the market, they're the ones that drag down the averages. Fidelity did a study back in the 90s. It was Peter Lynch and John Vander Heiden of Fidelity who looked at the market from 1981 to 1991, and they said if you missed just the best 10 trading days, an average of 1 day per year, you reduced your return from 14% on an annual basis. It was a very good time from 1981 to 1991. You reduced your return from 14% to 4%. Carla Freed for Money Magazine updated that in August of 2007, looking at that time period from 1982 to 2001, a time in which the Standard & Poor's was up 11.8%. During that period of time, 10,000 invested in the Standard & Poor's 500 would have grown to 93,000. But if you missed just the 10 best days, 1 day every other year, if you missed just the best 10 days, the return would have dropped to 56,000. If you missed just the best 30 days, an average of 1.5 days per year, instead of 93,000, the portfolio would be 28. And if you missed the best 50 days, just 2.5 days per year, instead of having 93,000, that 10,000 would have only grown to 15,000. Yeah, the truth is you can improve your returns even more if you miss the worst days. But then you're into trading. You're guessing what are going to be the worst days and when do you get back in. With a buy and hold, if you're well positioned, if you're in the right positions and the right stocks, you can ride through the tough times and still have better returns. That's why all this negativity, it gets people out, but yet it doesn't work. Just a 1% reduction in returns reduces over 20 years the total nest egg. If you plan for $1 million in retirement, you can easily sustain a 20% drop in the market if you get 1% better return. With a 2% return, you can sustain and have the same amount of money with a 40% drop. So you can withstand a 2008, 2009 drop in the market and still have as much money as you would have had if you were below 2%. The impact of performance is enormous. It may 1% or 2% may not seem like very much, but when you multiply that out over the years, it has a tremendous impact. I came through a number of firms. I was with Wall Street firms for much of my career, for 20 years of my career. And the firms kept saying, sell the relationship, not the performance. The question is that really in the client's best interest? The firms want you to really like your financial advisor. The firms really want you to develop a relationship so that you overlook what the performance is. Very few financial advisors publish their track record. Most will not give it. Most firms won't allow it. The book Backstage Wall Street says most financial advisors are world-class salesmen, the very best at sales. They build great relationships, but they know next to nothing about really investing and doing well. Something to think about. The last year, has been basically flat. It's where we go from here. I hear time and again from the pundits, the people that are around, and financial advisors who talk about reducing client expectations. They want clients to think low returns so that they look great. Reminds me of the manufacturing company that would tell their salespeople to promise delivery in 3 weeks if they really expected to actually do it in 2. Because if you tell somebody you'll deliver in 3 weeks and it happens in 2, you look like a hero. If you tell somebody 2 weeks and there's actually a delay and it's 3 weeks, you're really a dud. So it is to lower expectations, to get clients to think they should have a lower return. And when the returns come at 5 or 6 or 7%, then the financial advisor looks wonderful. No, but that's not really true. What that really does is it reduces the amount of money you will have for retirement or for children's education or for doing some of the fun things that you want to do. Anyway, that's where we sit today. I have a great guest, and I just want to remind you to stick around for the whole program because I want to tell you about those missing children, an astonishing number of children that just disappeared in one day. American children. I think very few people know this story, and I find it fascinating. And I think there's some application to investing. But that's coming later. First, I want to introduce Steve Wick, who is with Incisal Edge Sleep. Did I say that correct?
Correct, yes.
Welcome to the program, Steve.
Thank you, Mike.
Why don't we start with your background?
I graduated from Seattle University in 1986 and have spent my entire career in the dental field, bringing new technology to dentists. And about 7 years ago now, I was diagnosed with something called obstructive sleep apnea. And I realized that there were a lot of people out there suffering like I was, that they were undiagnosed, and that became my passion. And so for the last 7 years, I've been in the sleep apnea field.
So you say there's a lot of people that are undiagnosed, or a lot of people that have sleep apnea. Give us an idea of what a lot of people means.
Today, conservatively, there are probably 40 million Americans walking around, and 90% of those people are undiagnosed.
So essentially, that's more than 10% of the population.
Correct.
And 90% undiagnosed.
Yes.
So tell us what sleep apnea is.
Sleep apnea is essentially when you go to sleep, your airway collapses and you quit breathing. So if you think about a garden hose, as that garden, when your muscles relax, you lay back, the garden hose starts to shrink. As it gets narrower, the air speed or turbulence speeds up, and it causes your soft tissue to vibrate, and that is what we hear with snoring. As the tissue continues to contract and the airway finally collapses, that's what's called sleep apnea. And the way we measure that severity is how many times you quit breathing in an hour for a minimum of 10 seconds.
So you quit breathing completely
Yes.
for a period of 10 seconds.
Yes.
And how often does a person with sleep apnea usually?
The severity is based on the number of times per hour, and I can give you my personal example. It happened 73 times every hour. And what your body does is essentially say, wake up, stupid, you're not breathing. It sends a shot of the hormone cortisol to your system, which is the fight or flight hormone, and then also it sends a shot of adrenaline to your heart. And that makes you wake up quickly, you start breathing again, you go back to sleep, and you repeat the cycle over and over.
Wow. So what are some of the symptoms of sleep?
Symptoms, snoring is a big symptom. Daytime sleepiness. You're tired, fatigued all during the day. High blood pressure is a consequence. And there's an easy questionnaire that we can talk about in a minute that can actually people can go online and look at. It's called the Stop Bank, and simply answer the 8 questions. And if you answer positively to 5 or more, you're at high risk for sleep apnea.
We're going to come back and talk about those 8 questions after the break. We're coming up very shortly to a break. So I want to wait until we have time to really go through the questions. But what happens to some of the people who experience some of these side effects? I would imagine you have people that are actually employed and have problems. Before you answer that, we're going to come to a commercial break, and so you got to stick around and hear the answer to that. Don't go away. We got more to come. We'll be right back after this commercial break.
For more information, click on adamsfinancialconcepts.com.
Get a good job with more pay, you're okay.
Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
How much you could save.
That's close enough. We got it. Okay.
Now we return to About Money. There's more information waiting for you at adamsfinancialconcepts.com. Here again is your host, Mike Adams.
I'm here with Steve of Incisal Edge Sleep, if I said that correctly. We started talking about the questions that somebody could ask if they're suffering from sleep apnea. 90% of people are undiagnosed, but if they answer positive to 5 of these questions, they probably have sleep apnea?
About 87% chance, yes.
Okay, so what questions? Let's go one by one.
Well, it's called a stop bang, and the S stands for, do you snore loudly enough to be heard through a closed door? The T is, do you feel tired or fatigued during the day? The O is, has anyone observed you stop breathing while you sleep? And the P is, do you suffer from high blood pressure? So that's the stop portion.
So, and usually these are things that you don't see yourself.
Exactly. And that's why people are undiagnosed. They don't know what they're doing when they're sleeping. So oftentimes a bed partner will point these things out to them.
I mean, I snore, but I don't hear myself snore.
Correct.
So I'm taking my wife's word for it.
Yeah, I snored until I got treated, and I got the ribs, bruised ribs to prove it. So.
Yeah.
The second part is the bang part, and the B stands for your body mass index, or BMI, and there's actually if you Google BMI calculator, you can come up with what your BMI is. The A is for age. Are you 50 years or older? The N is for neck circumference. So for men, if your neck is greater than 16.5 inches, or for women, greater than 15, that would be a positive response. And the G is for gender, and unfortunately, if you're a male, you're predisposed to sleep apnea. So you look at those 8 questions, and if you answer yes to 5 or more, you're at very high risk for sleep apnea.
And 87% of the people who answer 5 or more will actually have sleep apnea.
Correct.
So what happens? Can we go through those questions one more time, so if somebody's listening, wants to write these down, or wants to answer the questions as we're going through, they can do that?
Sure. And also you can Google stop bang, and you'll get the questions online. But S is, do you snore loudly enough to be heard through a closed door? T is, do you feel tired or fatigued during the day? O, has anybody observed you stop breathing while you're sleeping? P, do you have high blood pressure? B is your body mass index, is it greater than 35? A is your age, are you older than 50? N is your neck circumference, so again, men 16.5 inches and women 15 inches. And G is the gender, are you male or not?
Okay.
So pretty simple questions.
Pretty simple questions. Answer 5 or more, and then what do you do? Suppose you answer 5 or more yes.
Well, the next step is to get the only way we can truly verify that you have sleep apnea is with a sleep study. So you would contact a sleep physician, and in the past, you'd spend a night in a hospital or a sleep lab. Today, oftentimes because of insurance issues, we do home sleep testing now. And so you get a device, you take it home, you sleep in your own bed, you bring the device back to the physician, and then they do a diagnosis, interpretation of the results. And typically, they will prescribe what's called a CPAP. And a CPAP stands for continuous positive air pressure. And if you think of it, an analogy would be you're putting a mask on your face, attaching it to a vacuum that's running in reverse, and so it's blowing air down your throat, keeping your throat open all night long, which is obviously not the ideal way to sleep. So unfortunately, the people who have been diagnosed and been given CPAP as their treatment alternative, within 2 years, about 50% of those people have given up on the therapy. So they know they're sick. This disease contributes to heart disease, hypertension, Alzheimer's, early onset dementia, cancer. All types of diseases are exacerbated by sleep apnea. So these people know they're very sick, but they've discontinued treatment.
I want to go back again to the questions. So you answer 5 of the questions, and you go to your doctor. What happens at that point?
Again, you would have hopefully your physician would, if you go back to your primary care physician, they would understand the seriousness of this disease. They would refer you to a sleep specialist who would then you'd have the sleep study done.
And the sleep study comes back and shows that you have sleep apnea. What happens then?
Then again, traditionally, you would be given CPAP, unfortunately. And because of the complications with sleeping with sleep app, 50% are non-compliant within 2 years. There are alternative therapies, but oftentimes they aren't mentioned to the patient to begin with, unfortunately.
But don't a lot of times people go to their dentist?
They do, and that's the ideal place to be screened for sleep apnea is actually in the dental chair, because there are signs and symptoms in the mouth that dentists can see. They can easily administer the stop bang questionnaire, and at that point, when they've determined that there's a problem, in the past they would refer you then back to your doctor or back to your sleep physician. We go through the whole cycle again, and you'd end up with a CPAP. What we've done to streamline the process is create a cloud-based system where if you answer 5 or more questions positively, the tablet that you take the test on auto scores it and sends a referral to a home sleep testing company, who then sends the device out to your house. You use the device overnight, send it back. The sleep physician does the diagnosis and then sends that information back to the dentist. And so then you meet with your dentist, and if your sleep apnea is not severe but mild to moderate, the dentist will use an oral appliance rather than a CPAP.
Okay. So, and you actually represent the CPAP, or not the CPAP, but the oral appliance.
Well, I actually represent, what I do is I educate dentists, number one, on how to identify patients in their practice. I teach them about sleep apnea. I try and encourage physicians to prescribe more oral appliances because they're more tolerable. And then I've created the software to allow them to talk to each other via the cloud and eliminate a lot of the challenges that we've faced in the past.
You know, I have a couple friends who both have sleep apnea, and I've gone through the overnight at the hospital to be wired up and hooked up, and fortunately didn't have it. But there's some real ramifications for people that have sleep apnea that don't realize they have it. Truck drivers and bus drivers and some of the things that have happened. You must hear a number of those stories.
Absolutely, and some ones that come to mind immediately. People remember the Exxon Valdez oil spill. Mm-hmm. The captain that was responsible for that ship was asleep and was diagnosed with sleep apnea. The Chernobyl nuclear disaster in Russia. The men at the controls at Chernobyl had sleep apnea. There have been 2 major train derailments on the East Coast in the last year. Both conductors had sleep apnea and were actually asleep driving the train. There are 100,000 car crashes a year are attributed to fatigue driving, which is $2.5 billion in monetary loss. Let alone sleep-deprived workers cost their employers about $63 billion a year.
It's a significant problem.
Yeah.
Going to sleep at the wheel is not just a joke.
Exactly.
It is true. So if someone wanted to deal with this, how would they get a hold of you? How would they?
You can reach me at steve@incisaledgesleep.com. Another resource for you is there is a group that I work with out of Bellevue called Premier Sleep, and they treat patients with oral appliance therapy, which again is much more tolerable than CPAP. They're also a very good first stop to start the consultation process. They won't diagnose you, but they'll steer you in the right direction and get you to the right people to make that diagnosis. And then if the oral appliance therapy is appropriate, they'll treat you.
Well, it certainly is an issue, and many people who snore don't have sleep apnea, but by far the large majority do.
And the interesting thing about snoring is that New England Journal of Medicine study in 2013 showed that just snoring alone, so you don't have sleep apnea, but you're just a primary snorer, takes 10 years off your life. Essentially what's happening is that vibration from the turbulence causes plaque in your carotid artery to break loose and goes to your brain and causes a stroke. So even snoring is serious.
Snoring is serious. Thanks, Steve, for being on the program.
Thank
Very
you.
informative. Big issue. Something that needs attention. Everyone should pay attention.
Well, I appreciate you having me on.
So I want to shift. I will get to the missing children eventually. I will get there. Mitch Anthony wrote a couple articles for Financial Advisor magazine last year. Talked about the 4 white lies about money. 4 lies. One of the lies is that money will make you safe. Another lie is that money will make you secure. A third lie is money will give you peace of mind. And the fourth lie is that money will make you somebody. And he talked about those issues as lies. Money making you safe. It promises, that's a promise it can't deliver. It can't protect you from risk or harm. The more money you have, actually, the more of a target you become. And if you've got some money, you know you face things with scams, con games, all those things that happen. You know, having health insurance is one thing, but it can't keep you from or stop you from having cancer or heart disease. You know, the best insurance in the world is not going to stop you from having cancer. It's a way to pay for it, a way to treat it, but it's not going to stop it. Your job, if you lose your job, the benefits can disappear. You can retire with benefits, and then the company has a filing of Chapter 11 or Chapter 7. Think about the people whose pension was at Kodak. They had money at Kodak in their pension fund, and that all disappeared. We're going to come back to that. And I'm also going to talk about those children. Don't go away. We'll be right back.
Stay tuned. About Money returns in a moment with Mike Adams here on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Lots of people manage investment portfolios. Just a few can manage a successful portfolio and provide exceedingly great service to their clients. Here's Mike Adams from Adams Financial Concepts.
We believe the price you pay should be based on the performance of your portfolio and the quality of service you receive.
You know, Mike, it seems that a lot of companies subscribe to the one-size-fits-all mentality of investing. Does one size really fit all?
Not with us. Every portfolio that we manage is customized to fit each particular client's objectives and risk tolerance. We place our client's interests first in all portfolio decisions.
If you're looking for a home for your 7-figure plus investment portfolio, call Mike Adams of Adams Financial Concepts, specializing in creating and maintaining wealth for over 20 years. 206-903-1019. That's 206-903-1019. Or log on to adamsfinancialconcepts.com.
About Money continues. Remember the website adamsfinancialconcepts.com. Here's Mike.
So I'm talking about some articles that Mitch Anthony wrote about in Financial Advisor magazine about a year ago. He talked about the lies about money. One of those lies was that money will make you secure. Nothing of value can be taken away. You know that if there's little risk, there's little reward. And you've also heard about those investments that can't miss. Getting in on the ground floor, there's no risk. Those are the things which tend to be chocolate-covered hand grenades. They look so good, and yet they blow up. There's no free lunch. You know, there's no way to prevent your house from burning down. There are ways and a lot of things you can do, but if your house burns down, it can burn down. Tenants, during the down market, during 2008, 2009, with the need for income coming in, if you owned a building, tenants were leaving those buildings and leaving. Savings are insured to $250,000, but that's all. Stocks are only as good as the management, and picking the right stocks is an art. It's not a science. Bonds and insurance policies are only as good and only as solvent as the companies that back them up. Everyone and everything is at risk. People tend to be greedy. People tend to jump on financial bandwagons, and people tend to do stupid things with money. It's just like following advice from a financial advisor because you like the guy. You listen to the stories that sound so good, but oftentimes they don't work, and it happens again and again. Money is not something that can guarantee your security. Even job security. 2008 to 2009, jobs were supposed to be secure at big companies, but like the big bad wolf, they get eaten away. Companies are not worried about your job. They're worried about the company and the finances. That's not security. That's not job security. It's not financial security. Another lie is that you can't have peace of mind with money. Without money, if that was true, the insurance industry would disappear. If you read the insurance policies, there's a thing called acts of God. It happens. Things happen, you don't get the insurance. 43% of North Americans take mood-altering prescriptions on a regular basis. 25% of women over 50 are addicted to prescription drugs. Paxil and Zoloft rate as the 7th and 8th best-selling drugs, prescription drugs. Money just doesn't give you peace of mind. 25% of North American adults suffer at least a major depressive episode at some point. Peace of mind comes from spiritual values, not monetary values. And, in terms of making you somebody, you can buy a bed, but you can't buy sleep. Anthony uses Letterman's things. You can buy a bed, but you can't buy sleep. You can buy a book, but you can't buy brains. You can buy food, but you can't buy an appetite. You can buy fine things, but you can't buy beauty. You can buy a house, but not a home. You can buy medicine, but not health. You can buy luxuries, but not culture. You can buy amusements, but not happiness. You can buy companions, but not friends. You can buy flattery, but not respect. The guy that started the cognac factory in Georgia had a sign, the country of Georgia, not the state of Georgia, had a sign which I liked very, very much. He said, "Money is a terrible boss, but it's a wonderful servant." Money is a terrible boss, but a wonderful servant. Think about that as you go along. Money is not the best thing to serve. It should be something that serves you. So anyway, one day, a huge number of children disappeared. And I want to tell you the rest of the story. Prior to 1987, parents didn't have to list their children on their tax returns. They didn't have to list the Social Security numbers on their tax returns. But on April 15th, 1987, it was a requirement to list your dependents, including Social Security numbers. And on April 15th, 1987, 7 million children disappeared. Think about that. 7 million children that were supposedly dependents on tax returns disappeared when they had to list the actual number. Think about that. Even at the low tax rates, that's $3.5 billion that was missing from people paying taxes. $3.5 billion in taxes they didn't pay. You know, the financial business today, many people listen to what's being said without any proof that it's there. What happened with those tax returns is until the government required proof that those children really existed, people filing tax returns added 7 million children that didn't exist. But it's not just on tax returns, because you listen to what financial advisors say today, what you hear from financial experts. You listen to what they say, but there's no real proof. You know, I have heard people who have been told by financial advisors that their returns are low because they took less risk. Really? Really? Do you believe that? No, I don't believe that. I believe they were poor investments. But you justify it by saying, oh, we took less risk. A lot of people looked at financial plans which were supposed to have uncorrelated assets. So if one thing went down, another thing went up. It was uncorrelated. So you had protection, you had downside risk. And then came 2008, 2009. What happened? All those uncorrelated assets suddenly became correlated. Everything went down. You know, the fact is, do you like your financial advisor enough to give up the potential returns that you're giving up? Dalbar puts out a study every year on comparing the returns of the average mutual fund investor, those who do it themselves, those who do it with financial advisors, the average financial returns, and what the Standard & Poor's did. And they look at it over a long period of time, because over a short period of time, it doesn't show very much. But if you look at it over a long period of time, 20 years or 30 years, very, very significant. Dalbar now has it for 30 years. The average mutual investor who would have invested $100,000 would have seen their account grow to $286,000 if they were invested in mutual funds. Stock mutual funds, that looks pretty good. But you know what? Had they just been in the Standard & Poor's, not $286,000, but $2.1 million. Did they take less risk? Are you willing to say that you've had less risk and willing to settle for $286,000 versus $2.1 million? Come on, it's not bad. It's not reducing risk. It's bad investment advice. Think about it. Think about it at your position and your portfolio, and then do something about it. That wraps up today. Have a very wonderful weekend. It's going to be 90 degrees, but the summertime is here. Have a great weekend, and I'll be back next Friday.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you want Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared on the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Friday afternoon at 3 for more About Money with Mike Adams, here on Business Radio 1300 KKOL.
The preceding program was sponsored by Adams Financial Concepts. Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
The following